I guess, the surprise for me. I thought COVID could potentially really shut us down. It did in the first couple of months. I think people didn't know how to react. Drill programs were shut down globally because governments put in place very restrictive practices. And then really within a couple of months, we were back on the ground, and we've been drilling in Quebec, Guatemala, all over Canada, and really haven't lost that much in terms of our efficiencies. And in fact, some areas I think we've improved.
Welcome back to Liberty and Finance. We have a first-time guest today, as well as a returning guest. John Robbins is the co-founder of Discovery Group. He joins us this first time. And Rick Rule is a returning guest, the CEO of Sprott Asset Management. John and Rick, thank you for joining us again here on Liberty and Finance.
Pleasure.
Well, thank you.
John, we were introduced to you through our mutual acquaintance, Jim Patterson, and he's the co-founder, as I understand, of Discovery Group. And we have some questions specifically for you about Discovery Group, which has been of interest to our subscribers. And Rick, who's often been on our channel, has been a voice of perspective and helping us to see value where it may be found in both discovery and junior miners and royalty and streaming companies and so on. So he was here to chime in on industry observations in general, as well as specific aspects of Discovery Group that catch his eye, since he handpicked you as one of the attendees at the Sprott Natural Resource Symposium in Vancouver. So, well, it was supposed to be in Vancouver. It was virtual this year. But anyway, hopefully next year in Vancouver. So if we could jump on into some questions about the industry and the environment in which we find ourselves here at the end of 2020, and then we'll look at some questions about Discovery Group in specific. But this is for both you gentlemen, I guess what maybe comes to top of mind for you as maybe the greatest surprise to you that's come out of the year 2020. John, would you go first?
Sure. Well, 2020 has been an interesting year, which is a huge understatement. I mean, obviously, COVID has changed the landscape dramatically. Obviously, it brought about, in part, a strong move in the price of gold, and more recently with the stimulus packages that are being talked about, a good move in base metal prices. So we've had kind of, on one hand, an event that's global, that's affected how we do business. But on the same token, it's provided some great opportunities in terms of metal prices. What surprised me, I guess, is how quickly our industry was able to adapt to a new environment, kind of a new paradigm in terms of working from home and these endless Zoom calls like the one we're on today. But I would say, for the most part, in our group, and we have several companies in our group that are working all around the world, it's affected us in some areas. But for the most part, I would say the impact has been relatively negligible, which is, I guess, the surprise for me. I thought COVID could potentially really shut us down. It did in the first couple of months. I think people didn't know how to react. Drill programs were shut down globally because governments put in place very restrictive practices. And then really within a couple of months, we were back on the ground, and we've been drilling in Quebec, Guatemala, all over Canada, and really haven't lost that much in terms of our efficiencies. And in fact, some areas I think we've improved. So I guess for me, that's the biggest thing, is just how COVID impacted metal prices, the enormous amounts of debt that are being, dropped onto our respective economies, and the impact on metals. That's kind of, I'm looking forward to the end of 2020 though. It's time to move on.
Hopefully with the end of 2020, we might see the end of some of these other anomalies. But Rick, how about for you? The greatest surprise of 2020 from your seat?
Two surprises, really. The first surprise is kind of perpetual for me. The fact that it took gold so long to catch a bid. We joke at Sprott, having worked on our franchise through the whole decade between 2010 and 2020, that we worked 8 years to become overnight successes. And I'm surprised that the deficit spending and the collective idiocy in the United States, Canada, and other countries didn't cause people to exhibit fear earlier. But obviously, COVID let people see that the policy responses that have been in place for the better part of 20 years would continue and, in fact, accelerate. So fear, I guess, finally caught hold. The second surprise, and this really is a surprise limited to 2020, was that this bull market, this precious metals bull market, in terms of leadership, moved right straight from the best of the best, which is to say the Francos, the Wheatons, and the Barricks, all the way down to the exploration sector and beyond to the penny dreadfuls. The move that we saw beginning in June, where all of the juniors got a bid, irrespective of quality, is much more reminiscent of the end of a bull market than the beginning of a bull market, and would have scared me, in fact, except for that so much value occurs in the middle part of the sector. What has been useful for me very recently is that as the air has come out of the juniors, the air has come out of the good, the bad, and the ugly. And we don't have any particular need to buy the bad and the ugly. And so the fact that many of the good were able to finance at very high prices indeed in the summer, and now are selling at sometimes 20 and 30% discounts to the financing prices and doing good work, is a benefit. But as I say, the real surprise to me was the change in market leadership that didn't follow down by market cap the way it has in prior bull markets, but in fact went right straight from the biggest institutional favorites to the sort of Robin Hood crowd without skipping a beat.
You know, you made me think of two things when you were describing that. One is the saying that we have in the preparedness community, and John might not be familiar, but the heritage of our channel, Liberty and Finance, used to be called reluctant preppers, because a lot of our audience are firmly entrenched in the idea that it's necessary for us to take responsibility for our own well-being and the preparedness of our families and our financial security. And that's what led us into sound money, gold and silver in the first place. But you mentioned how Sprott spent a decade getting correctly positioned before it started to show itself. And the old saying in the preparedness community is, I'd rather be 7 years early than 1 day late. So thank you for voting with your feet and getting not only yourself, but all your clients in the right position ahead of time. The other thing was, you mentioned juniors awakening surprisingly early at the what was going to be the start of a bull run in precious metals. One thought that occurred to me is that what you were describing was this protracted delay of how long it took for this awakening to happen about concerns and reasons for breaking from the mainstream narrative in terms of the seriousness of debt and currency overexpansion, that sort of thing. Is it perhaps then that we might be closer to a climactic, in other words, maybe it wasn't so early in the cycle, maybe there was this delay, but now everybody's playing catch up because they realize suddenly not only that they weren't paying attention, but the fact that they weren't paying attention for a long time?
I think rather that it is a change in the way that information is distributed and gathered. The mining industry traditionally has had investment information distributed by investment banks from on high. Information is starting to be distributed by people like you, peer-to-peer. And many of the people who consume peer-to-peer information are at least as interested in speculation as they are investment. And so my suspicion is that what we are beginning to see is the effects of disintermediation on the information distribution platforms around the world, which is probably a very good thing. The investment banks did an extremely good job of distributing information about what they and their principals were long. But the truth is, over 40 years probably didn't do investors any favor. And so the idea that there are a multiplicity of sources of information and users begin to feel both the power and the need to identify, sort, and use information of their own volition rather than being force-fed from on high, I think is a very good thing, and probably very, very, very good for your guest at Discovery Group. Breaking the logjam, if you will, of information distribution by the investment banks, I think is a good thing for everyone, except, of course, them.
Yeah, that's a very interesting thought process. Any follow-up comments from you, John, before we move into some specific questions about Discovery?
Well, I think I echo what Rick said. It was very surprising to me to see how quickly money went down the food chain. In the spring and summer, I've never seen so many requests for, here, we're doing another financing in this company I'd never heard of. And here's another one and another one. There's literally hundreds of them done. And that always causes me a bit of concern because, like Rick said, that's often the warning signal at the end of a bull market. But I think that there are some elements to that I draw comfort from. A lot of people have been saying that the retail shareholder is gone. Money has gone to managed accounts. Retail shareholders in the mining space is, they're becoming rarer and rarer. And that was all retail. And even some of our financings of late, which have been, not insignificant, have been hugely retail driven. So the good news is that the retail shareholder is still there. I think that it was a little surprising that the money went down the food chain so quickly and completely ignored a lot of development stories. Like within our own camp, we have a project that's nearing construction. Those development stories have, in a way, have been largely sort of overlooked in the last, 6 months, while, earlier stage projects have been getting all the notoriety. But I do draw comfort from the fact that the retail shareholder is alive and well. I think a lot of that money came out of the marijuana space. It's maybe not as educated as it could be. But, we've had a fantastic year in our shop. So, and I think it's just the beginning. There's nothing to point towards metal prices falling. So, I think it's net, it's been a very positive move for us.
Could you tell us more about how Discovery Group came to be? It's not obvious to many people why there would be a group of discovery companies, that sort of thing. How is that something that you decided was needed, and what was your core mission there?
Well, my background, I'm an exploration geologist by trade. And unlike a lot of geologists who came out of university and went to work for one of the big companies, I took a slightly different path and stayed private for the first 20 years of my career doing prospect generation, staking claims, prospecting, selling them. And it was a great business model, but it had limitations. Obviously, when you're spending your own money, there's a limit to how much you can develop a project on. So I started getting involved in the public company space in the 1990s and early 2000s, and started working with a number of different companies. We formed a couple ourselves, and that was sort of the genesis of Discovery Group, wanting to work together and take advantage of the synergies and the collaboration that comes with working with really good people. And another thing that was important is that I looked around and I saw a number of these groups that were essentially for-profit enterprises. They would charge management fees, and really these groups were a guise for a profit center for the insiders. And I definitely didn't want that to be what we were known for. Really, it was about working with good people, continuing to explore and develop exciting projects. But Jim and I made it clear from the very beginning that this was meant to be revenue neutral. It's really a platform of collaboration. So that was kind of the basis of it. And we've maintained that right to this day. Discovery is not a revenue generating enterprise. It's just an umbrella organization for a bunch of like-minded explorationists, people that are driven by the science and the love for exploration. And obviously, we're still capitalists, so we're not completely altruistic. We're doing it to make good returns for our shareholders and and ourselves.
And I guess, Rick, I would ask you, what caught your attention about Discovery Group? Because clearly something did. You're a student of value, and you look for it wherever you turn. So what drew your eye?
Well, I've known John since he was sort of a pimply-faced geologist flying a single-engine plane through northern Canada in the old Discovery syndicates. And I've always had a sense of humor for both his intelligence and his parsimoniousness, neither of which are well distributed, sadly, in the exploration community. For responsible people who form, in effect, co-ops, which is to say, multiple issuers on one roof, where they don't, as he says, basically just chop up the shareholder, but rather where they chop up the bills, where 6 companies share a copier, a receptionist, coffee, rent, all those types of things. It ends up leaving less money going to G&A and more money going into the ground. And G&A costs me money, and going into the ground occasionally makes me money, which attracts me.
Okay.
I'm of two minds. There are a lot of multi-company groups, and I have made money, as an example, going back over the years, a lot of money with people like Ross Beatty and Lucas Lundin, who have had multi-company groups. I've made a lot of money with guys like Bob Quartermain, who say, I'm going to do one deal at a time, even if it takes me 7 or 8 years. You need to focus, I guess, as much on the people as on the method. But we're starting to see groups like Discovery fill the role, in a sense, that venture capitalists have fulfilled in Silicon Valley over time, providing adult supervision, providing shared services, providing access to a higher quality of investor at the same time that they provide access to greater types of opportunity. So it was precisely that led me to suggest that you should pay attention to, in particular, Discovery, but also some other groups like them.
That's interesting. Your description there of almost the value of curating potential value in juniors, that sort of thing, reminds me of what you do. I mean, you typically are trying to pull together, based on a broader view, those gold nuggets, so to speak, of firms that you think provide a value opportunity to your clients. And it sounds like, in a sense, that's an overlap of mission with rightly configured groups like Discovery. John, I guess, what do you feel has made Discovery Group so successful thus far?
There's a number of things, I guess, that sort of factor into that. Rick touched on it. It's people. You can have the best project out there, but if you don't have the right people to manage a company, to execute on the strategy, you'll not derive the best shareholder value. So we strive to work with, some of the best people in the industry. Integrity is a huge part of our mantra. I don't want to work with somebody that might be very bright, but has a weakness when it comes to their moral or corporate ethics. So we're very rigorous about that. The people that work with our group are really driven by the science and discovery and the exploration sort of side of things. I mean, now we have two royalty companies that are mixed, a little bit different story, but still the same sort of mantra. So people is an incredibly big part of it. Integrity. And then obviously you have to have a good eye for projects. And, I've been fortunate enough to have been in the business for far too many years now. I think my first field season was 1981. Seen a lot of projects. I have a good sense for what works and what doesn't. I think it's incredibly important from the get-go is to have an exit strategy. Now, an exit strategy could be building a mine and taking it all the way through to production. It could be a project that you think you can sell to a major. But where a lot of companies fall down is that they really don't have a corporate strategy. Oh, what's your end game? If it's just endless amounts of grassroots exploration, your chances statistically of the win are very, very low. So you've got to find projects that you think have that home run potential. So I guess that's kind of it in a nutshell for us.
Could you follow on, and then I'll get Rick to weigh in on this as well, but specifically what do you're looking for in a discovery group eligible company? You did mention people, and maybe you want to elaborate a little bit on that, but what are you looking for when you're picking out a company that would be a good fit for discovery group?
Sure. Well, originally, Discovery Group was formed or made up of companies that I or myself and Jim had formed right from the beginning. So we might look at, creating a gold exploration company in Nunavut, or a uranium company, or some of that. We would form the company, build a management team around it, and identify a project, or perhaps the reverse, get a project and build a team around it. And we would do that right from the ground up. Over the last few years, there's been a few companies that have come into our shop that we didn't form, but they were being led by, young, bright people that you could see had that kind of star quality, but maybe we're missing, a bit of mentorship, access to capital markets. Rick mentioned this sort of Silicon Valley model. I mean, one of the things that we provide is that initial startup capital, the initial money to get going, and we have very strong connections within the capital market space, so we can bring money to the table, and we bring sort of the skilled directors to the team, and take groups that have a component or two of the right sort of secret sauce, but maybe not everything, and we can backfill that and take it from there.
Rick, if you could weigh in on that as far as the value you see of this incubation model that groups, if they're properly constructed, can provide.
Well, I think it's important. One of the things that John probably neglected to mention is that in addition to having both himself and inside his group a good eye for property, when you've been in the business for as many years as he has and you've had as much success, you have better access to properties. It's one thing to have an eye. You have to have 200 or 300 inbounds in the course of a couple of years to find a couple of good things to do. I was always impressed working with, as an example, Robert Friedland, or in the old days, Adolf Lundin, how much stuff they got to see. Because they could fund it, because they had a track record of success, there was this wonderful virtuous circle. And what happens when your group, through multi-companies, gets sufficient critical mass, the prospecting community, the investment banking community, the mining companies who aren't advancing a project but think that somebody else could do a better job with it and want to turn it into cash, you become their first stop. Whereas the sort of struggling geologist backed by a butcher, a baker, and a candlestick maker, was sort of a basement office in some distal part of downtown Vancouver, doesn't stand a chance, either in terms of access to properties or the ability to vet properties, and certainly doesn't have the same access to team building, seed capital, capital markets.
Well, that makes sense. I mean, you've talked to us multiple times in the past about how you said scale begets scale, or success begets success, or in the case of discovery, luck tends to beget luck. In other words, people are serially lucky or serially successful, and maybe some of the secrets behind that is okay. It's partly attitude, it's partly approach, it's partly the people they surround themselves with, and the ethics that John, you mentioned. But Rick, one of the things you're talking about is just this gravitation, this natural critical mass that forms around people who are doing things in an intelligent and ethical way that will just draw opportunities to them. And that makes perfect sense.
Correct. A younger Rick Rule in his 30s might have sought on a single company basis to do some of the stuff that John does for me. That is, mentor these young teams, do all that stuff. In my declining years, I'd rather John did it than I did it. And I think that a lot of investors that are where I am in life, there's probably 20 of us worldwide in the mining business, who would prefer to partner with teams that were responsible for the hand-holding and the direction and the mentoring. as opposed to, which I did a lot of in my 30s, doing that myself. I remember many years ago, 30 years ago, explaining to Ross Beatty, who has become an extremely sophisticated capital markets guy, what the various differences were between good shells and bad shells, and how to avoid getting sandbagged by the Vancouver brokers. I mean, I remember having to do this myself with people who were smart enough that they went on to become what Ross Beatty has become. But at this stage in my career, I would rather do it alongside other people rather than be responsible for every aspect of a success myself.
I got to give you a hard time here because unlike 30-somethings like me and John here, you calling yourself in your declining years, you're not that much older than us, so you got to lighten up a little bit on that declining year stuff. But anyway, John, if we could circle back with you and understand some of the core principles that you're looking for, and that I guess if you were to say that if you look across all the companies in Discovery Group, what distilled together would you see as the core principles?
Well, I touched a bit on it before. I mean, some of our core principles, and it sounds perhaps a little glib, but integrity is absolutely core to our mantra in our group. Respect for the environment, corporate social responsibility. A lot of companies pay lip service to those principles, but the streets are littered with projects that have failed over the years because companies have not taken on those principles and really adhered to them. And it's not just something that you feel like you should do, it's something that we have to do. And our landscape is becoming more and more complicated. Canada, we've got, very complex issues with First Nations and environmental groups. And you really have to take a proactive approach. We're working right now. We have one of our most advanced project is in Guatemala, which, a lot of people have questioned my sanity in the past about doing. It's a complicated CSR landscape, but our team has done an amazing job. We've built out super strong relationships. And as a result of that, we're going to be the first new mine to go into production in that country in decades. So those are very core principles these days. It all still revolves around the people and the projects that you find, but it's how you conduct your business. And access to capital, you don't have access to capital if you don't have core principles like the ones I mentioned. Companies, the larger firms, retail, institutional investors now are becoming more and more concerned about, what you stand for, how you conduct your business. So those are the sort of core, I guess, principles within our group. And we simply just, like I've had, Rick mentioned it, deal flow and things like that. Absolutely, he's absolutely bang on. The more success we have, the more deal flow we've had. We've had all kinds of people saying, well, we want to be part of Discovery Group. And, our bar is pretty high. And the vast majority of people, we look at either the background of the people, the track record, and they just don't fit the bill for us. I mean, it has to be people. We do what we do because, first of all, we love our industry, and we have a great group of people that we work with. The collaboration around the sort of coffee room you can't beat. And we have no desire to work with people that we don't see carry those same principles with us.
Rick, I guess I was going to ask you just for your feedback on investors that approach you. How much of a voice are you hearing collectively of people seeking out something that's environmentally responsible, socially responsible, that sort of thing, as part of their overall investment picture?
Two schools. The institutional investor now, particularly the state-sponsored institutional investor, either sovereign wealth funds or public service pension funds, that's where they start the conversation. It seems to have become more important than return on capital employed. I won't talk about that at any length, perhaps. But the high net worth sophisticated retail investor has also come to understand that CSR or ESG is the key to ongoing funding. We're beginning to have a discussion within the industry now, which is really, I think, overdue and helpful as to what ESG really is. There has been, unfortunately, in the last 3 years or 4 years, a lot of paint by numbers, a lot of posturing, a lot of political correctness. And increasingly, the discussion around ESG is coming to do no harm in a real sense, not in a politically correct sense. If you unpack each of E and S and G, you will see that the mining industry had already made some pretty substantial strides.
I should probably hold us up here because one of the things I always try to do here is speak in the place of the audience. So for those of us this is new to, CSR and ESG stand for?
Environmental, social, and governance, or, and this is an obscenity, corporate social responsibility. It should be called corporate social opportunity. If we regarded this as an opportunity to run our businesses better, as opposed to a responsibility that allegedly atones for past sins, I think we'd do a better job with it. But the truth is that the mining industry in the 40 years that I've been involved in it has done an amazing job in terms of increasing its environmental stewardship, admittedly from atrocious to excellent. But the truth is, in terms of sustainability, mining occupies a very, very, very small footprint. It's extremely sustainable relative to the amount of economic activity it generates, relative to the land it disenfranchises. Some of your viewers will hate me for this, but the golf industry is much more environmentally destructive. Great big monocultures, usually in riparian areas, but they're green, so they're okay. Socially, too, we have done, and I gotta take my hat off to BC. The level of interaction with Aboriginal and Indigenous communities around the world that the mining business has exhibited in the last 20 years has been both astonishing and fruitful. And what's going on right now in northwestern British Columbia with the Tahltan, the Nisga'a, and the Shkukamlooksha is software that BC mining and exploration groups will be able to share worldwide. I think it's really, really, really important. So I think it's a great question, but it's one that needs to be discussed in its fullness rather than in politically correct terms.
That's refreshing. Thank you. John, anything to add to that before we go to some viewers' questions?
Just to say, I think what's happened in the last few years is that the tail really has been wagging the dog. A lot of companies feel that they have to embark on these programs and they wave a flag and they become less competitive and they spend far too much time, doing things that are really not meaningful. The principles that I talked about, we've done, it's not something that we've just embraced in the last few years because it's something that's necessary. It's the way we've conducted our business from day one. And you can have the best project on the planet, but if you don't have your social license, you'll never get you might have your mining license, but without your social license, the project will never be a success. So unfortunately, our pendulum has swung, way to the left here. But out of that has come a lot of very good things. And our industry has a lot to be proud of. We have rewritten sort of the whole book in terms of how resource companies should operate globally, not just in Canada, but we're governed by the same principles in Guatemala as we are governed by here. And that's incredibly important. And it's the key ultimately to the success of every company. You still have to have the project and the people, and you have to still realize that at the end of the day, it's our shareholders that we're accountable to, and we have to make sure that we're looking after their interests as well as the local people in whatever country or state or province we're operating in.
Yeah, and I think what Rick's pointing out too is that there's no inherent contradiction between those. Those can be perfectly aligned if you take the right attitude from the onset.
Absolutely.
Okay. This is a question for both you gents. Maybe we'll start with Rick. This is one you get, I'm sure, all the time, but it does come up all the time from our viewers. So we're going to give you another crack at it here. And then, John, we can get you to weigh in as well. How much longer do you think the precious metals bull market will be?
The easiest answer would be, I don't know. But
that's your standard first answer.
Looking at the Barron's Gold Mining Index charts, which I so often refer to on our interviews, what you learn is that real, true gold bull markets are of much greater duration than most people expect. I've been through two in my life, 1970 to 1981 and 2000 to 2011. Those were both 11-year markets, depending on how you measure this one. Let's say, just for fun, it started in 2017. So we're 3 years into an event that history guides us could be a 10-year event. They're also of much, I mean precious metals bull markets, are generally of much greater dimension than most people realize. When people on your show say, gold has moved from $1,100 to $1,850, have I missed the boat? In the last bull market that I went through, 2000 to 2011, the gold price moved from $253 to $1,900 an ounce. Is gold going to move sixfold this time? Probably not. But is gold going to react to quantitative easing, which, of course, if you and I did it, would be called counterfeiting? Is it going to move as a consequence of deficit spending? Is it going to move as a consequence of negative real interest rates? If 2,000 years of history with regards to gold and government are any guide, when people are concerned about what the government does to the purchasing power of their savings, traditionally they've gone to gold. So my suspicion is that until we see governments stop screwing with the currency, that is to say, end quantitative easing, end deficit spending, and end negative real interest rates, that it's very likely that we will continue to be in a precious metals and precious metals equities bull market.
John, any different perspectives that you bring to that discussion in addition to what Rick's shared?
Well, I mean, I'm by no means an economist, but it's interesting. I've never considered myself to be a gold bull, although the bulk of my career has been exploring for gold. In the very basic sort of view of things, I look at what's going on globally, the debt levels that are growing, throughout the Western world, tensions with China, the potential for inflation, all these things. I can't help but feel, point towards a very, good future for the price of gold. Do I want to live in a $5,000 an ounce gold environment? I'm not sure, because it brings with it a whole bunch of other things that go up that drive something like that. But I don't see us getting back to a $500 an ounce gold environment anytime soon. And, within our group, probably, 60% of our companies are focused on gold exploration, but, we're also very active in the base metal and PG space as well, too. So we've always had a mantra within our group to, diversify our commodity exposure and our, geographic exposure as well, too. So I think the future for gold will continue to be very robust. But with all the money that's going to be spent on infrastructure and whatnot, the base metal side of things looks very attractive as well, too.
Yeah, we've certainly seen awakening in Dr. Copper this year, that's for sure. Rick, we'll start with you if we could on this one. Yisip Yacht says, referring to your Barron Gold Miners Index that you shared, you make reference to 2 gold bull markets, which you did again, and I believe 6 recoveries from oversold bottoms. What distinguishes the two, and which one are we in right now?
A correction for your questioner, 8, perhaps 9 recoveries from oversold bottoms.
All right.
Those are cyclical advances in what can either be secular bull markets or secular bear markets. When an equity market or a metal market is oversold, that market often has a reflexive bounce. If you look back over 50 years of history documented by the Barron's Gold Mining Index, you will see 8 I believe, 9 demonstrable recoveries in bull markets and bear markets from oversold bottoms. Some of them very, very dramatic, taking place over periods of time as short as 9 months and as long as 40 months. That's very different from a secular bull market. A secular bull market can have within it several 20 or 25% cyclical declines in a secular bull market and still have that bull market intact. In my career, there have been 2, 1970 to 1981, and 2000 to, depending on how you count, 2008 or 2011, of substantial duration, which is to say 10 years plus, of substantial dimension. The gold price escalating in one case, 30-fold? And in the other case, 6.5-fold. A very different beast indeed.
John, any comments on that before we go to the next question?
The only thing I would say is, like, within our space, we obviously don't focus too much on overthinking cycles. Our group has done well in all aspects of these cycles, because when cycles are down, that's when the opportunities for acquisitions come into play. So for us, we don't get too bogged down in trying to predict where things are going to go or where they have been. I've lived through, a lot of these cycles, seen some crazy moves in the market. And every time we're in a down cycle, it's the end of the world. It's a paradigm shift. It's never going to get better. And it always does. And it's different, but, you just have to be nimble and take advantage of these cycles when you're in them. And I think the other, just from an explorationist standpoint and a developer standpoint, this is where an investor needs to look at the companies they're investing in, because, the timeline from exploration to production is getting longer and longer. And, you hear numbers of up to 20 years, from the time you make a discovery to potentially when you can permit something, depending on the location. And you look around, I know people that I went to school with that are still working on the same projects 35 years later. You need to have a group that has a track record of being able to monetize things when the cycle is right, and not be invested in something that has got a 20 or 30 year time horizon, because the reality is that you may not live long enough to get the value for it.
Now here you go starting now. That's fine. Follow-up question here. This is from BP. It's kind of in a similar vein. You guys have talked about, John, you mentioned base metals. Rick, you've brought up that several times, commodities and other potential natural resources that you would consider as precious metals bull market gets long in the tooth, what you'll be looking to next. BP says, if you were to focus on a portfolio exclusively on commodities with a high risk tolerance, what percentage right now would you consider being in precious metals, uranium, and base metals to be properly positioned to take advantage of price movements and such? Related question, what signs should we look forward to start moving out of gold and silver and into commodities like uranium, nickel, copper, etc.? So Rick, maybe you want to kick us off with that one?
Well, there's 2 questions there. So Let's do them in reverse order. The end of the gold bull market will be, in my view, related to the end of the circumstances that have generated it. So when you see major currency blocks end quantitative easing, when you see major economies like the United States cut their deficit to half of their annual growth rate, and when you see government interest rates return to their 3-decade mean, which is to say 200 to 250 basis points real positive, then the reason to own gold will go away. The reason to own gold stocks may not go away. There may be companies, groups of people who build a wonderful company in a horrific pricing environment, but the wind will no longer be at your back. I'm attracted to a range of commodities. As you know, Donegan, thus far, I've been way wrong about the copper price, mercifully, expecting it to get weak while it gets strong. And I'm delighted to be wrong. Hearkening back to what John said, Cycles happen to you and you have to take advantage of them. My slogan has always been, you must be a contrarian or you're going to be a victim. So if you look at the materials that are decidedly out of favor, agricultural minerals, decidedly out of favor. Phosphate, potash, decidedly out of favor. Oil and gas isn't merely out of favor, it's hated. So I'm attracted to it, Greta notwithstanding. And I am attracted to the uranium space, although a little bit less than I was 4 weeks ago when all the uranium stocks began popping higher. In terms of capital allocation, every investor wants a one-size-fits-all. In other words, they want me to say you need to be 50% in gold, 12% in uranium, 30% in base metals or something. That's impossible. 7.7 billion people, 7.7 billion portfolios. That's the way it works. The money will be the easiest to make in the near term in the precious metals market because wind is in precious metal sales. And the stocks are not expensive relative to the metal. Somebody who wants to really, really, really hit the ball over the fence, if they have the patience for the wait and they can afford to be wrong if they're wrong, from my point of view, is certainly uranium.
John, any thoughts on that idea of additional base metals that you expect will do well in the time going forward, following maybe in parallel with or subsequent to the precious metals run that Rick's been expecting?
I guess I'm going to touch on something a little different. First of all, I think it's impossible to say, as Rick said, you should have 30% in gold, 20% in copper. I think you always want to have a mix, but more important than the mix in commodities, or just as important, is the companies that you invest in, especially in the junior space. It is really difficult for an investor to weed out the chaff from the wheat. And in a bull market, we've seen this time and time again, you have a plethora of companies where insiders are loading up, heavily promoting their stocks. The projects underneath them have no real value, and it's a potential minefield for investors. So you really have to do your homework. I've always believed that you need to have a mix of commodity exposure. I've always done that in my own personal account, but it really comes down to the quality of the assets are in there. And then the other thing I would just say is that you might not be 100% bang on in a call on a particular commodity, but if the company or the project is a world-class commodity, you become a little agnostic about whether it's copper or zinc or what have you. If the project is a stellar project, it won't matter as much. On the uranium space, I'm a little jaded, and as Rick knows, we were heavily involved in the uranium exploration cycle. Uranium has been, I'll invest in uranium stocks. I won't personally run another uranium company because it's a metal that I think you can trade the companies that are in it, but it's a challenging commodity. And I just look at companies like NextGen as an example, one of the most amazing discoveries of the last 2 decades. And if that were a gold stock, it would be trading at multiples of where it's at right now. I'll invest in uranium companies, but I probably won't run another one. But I think the key is just finding a good example within our group is Fireweed. We have a zinc company that's predominantly zinc and silver, but it has the potential, like we're on the cusp of actually being able to say, honestly, it's a world-class asset. And ordinarily, I wouldn't have set out to go find myself a zinc project, but my view is that if you find the right asset and if it's good enough and it can have the right yield, it doesn't really matter whether it's zinc or copper. It's finding those world-class game-changing projects that do exist out there.
This question is close to the end here. It's one that has been on the mind and it's certainly been part of the public narrative a lot in the last couple of months. And that's the idea of this. Everything has changed now. There's a new paradigm since we have, for example, cryptocurrencies and that the whole role that gold and silver have played in humanity and in economies and so on as a basis of real money is now a paradigm shift and is going to be sunsetting. Roger Stansel says, how much longer will they ride the wave of the old dying paradigm before they jump ship? Rick, you mentioned earlier about way beyond the 100-year chart that this goes back and predates all kinds of eras of different dynasties and so on throughout history. What's your view of, for example, cryptocurrencies as the new gold versus gold's role going forward? Do we see a new paradigm?
No, I see as to sort of 98% of the economy, gold and crypto being complementary rather than competitive assets. They both provide what I think are wonderful moral alternatives to state-sponsored currencies, which I hope die a painful death, but not in my lifetime. The constituencies are different. The attraction of cryptocurrency has been anonymity, the fact that you don't need trust, in other words, the system itself has trust, and the frictionless nature of transactions. And that's all important. The problem is that in order for Bitcoin, as an example, to compete with gold as something other than a speculative medium, it has to be both a store of value and a medium of exchange. As a store of value, it has two challenges. It has no physical use. Its use is a network, and gold has a network too. The volatility it exhibits while it attracts speculators reduces its utility as a medium of exchange, because if somebody's life is denominated in US or Canadian dollars, but they're spending Bitcoin, when they go buy a cup of coffee at Starbucks, they don't actually know what they paid because of the insane price volatility of the Bitcoin, nor does Starbucks know what they received. So except for in very, very speculative hands, which is almost to say the Robin Hood crowd, gold and Bitcoin are complementary assets rather than competitive assets. Remember, Dunnigan, as I've said on numerous interviews in your show, the market share of precious metals and precious metals related investments in the United States, which is the largest savings and investment market in the world, is less than 0.5% of total savings and investment assets. The 3-decade mean market share of precious metals and precious metals related assets is between 1.5% and 2%. Given the fact that both on the major scale, Bitcoin and gold are floating anomalies, there's lots and lots and lots of room for both. I would suggest that the real challenge for gold in terms of diversion of savings will be the S&P 500. People have learned that equities themselves only go up. That isn't true, of course, but that's what people believe. And my suspicion is that if precious metals and precious metals related assets have a viable competitor as people are forced out of conventional savings products, it'll be conventional equity ETFs, not cryptocurrencies.
John, you mentioned before that with your focus on discovery and exploration and that sort of thing, maybe less of a focus on this topic, but your personal perspective on any new paradigm here.
When it comes to the cryptocurrency space, I recognize it exists. I don't pay much attention to it. I think it's a great platform, for people that are trying to be anonymous. There's a huge attraction to the criminal element, I think, if you're looking for that sort of thing. As Rick said, gold investments are such a small part of the overall sort of investment sort of thesis within the Western world. It takes a very small delta in terms of the number of people percentage-wise that decide to invest in gold to have an absolutely huge impact on our industry. As I said before, I don't spend a lot of time trying to predict or see where things are going to be heading to. Our focus is, if you're looking for a gold investment, we have some of the best gold exploration stories on the street within our group. If you're looking for a base metal exposure, we've got that. And people can make their own choices. The cryptocurrency thing I find fascinating. I think it'll have it has had a negligible effect on our industry and will continue to be such. I think at the end of the day, if you're looking for a hedge and something safe, an algorithm isn't safe. And really, that's all we're talking about when it comes to Bitcoin. With gold, there's something physical backing it, whether it's through an ETF, whether it's through a gold mining company or gold explorer, or the physical metal.
We also wanted, before we wrap here, or as we wrap, for each of you gentlemen to give people a chance to find out how to reach you if they want to find out more. Rick, could you go first and tell people your preferred methods for them to reach out to you?
Yes, absolutely delighted. Following on what John said, there's a plethora of junior miners out there, probably 2,000 of them worldwide, and probably 1,700 of them are a waste of the paper that they printed their share certificates on. There's probably 300.
Talk about environmental impact.
Probably 300 viable out of a 2,000 universe. Further to that, we at Sprott would like to help you separate the wheat from the chaff. Specifically, any of your listeners or subscribers who go to sprottusa.com/rankings and enter the names and symbols of your natural resource portfolio. Please, no non-natural resource stocks. Your natural resource stock portfolio. I will personally rank them 1 through 10, 1 being best, 10 being worst. Disclaimer, my rankings are extremely harsh. Don't be discouraged. I will personally comment on issues where I think my comments might have value. And if your readers include the word chart in their request, I will include the Barron's Gold Mining Index chart and a 100-year commodity chart, which puts the valuation of various industrial commodities relative to other asset classes going back 100 years into context.
Thank you for renewing that offer. We'll put that both on the video and in the description so people can get to that link. John, people want to find out more about Discovery Group and your member companies. Where should they find that out?
Well, the best place is obviously to go to our website, which is, if they do a search under discoverygroup.ca, they'll find us there. And, I'm happy to personally talk to anybody that's interested in any of our companies. So happy to share my email address as well too. I'm always interested in hearing people's perspectives and giving them my own. So I don't know if you'd like me to just give that right now, or whether you
sure, and I can put it in the description as well.
Sure. So I can be reached at john_robbins@telus.net. And I'll be happy to talk to any of the potential shareholders that might be out there.
Very good. Well, yeah, we've got a lot of viewers who are very interested in basically helping their family to not only survive, but thrive through this coming changes in our financial and economic landscape. And this is part of it. So just thank both you gentlemen for joining us here today on Liberty and Finance.
Thank you, Donegan.
Thank you very much.